Picture this. It's 2008, and the world's economy is about to come crashing down like a house of cards. Banks are collapsing, people are losing their homes and jobs, and the stock market is plummeting at an unprecedented rate. This was the reality of the 2008 financial crisis, a devastating event that left a lasting impact on the global economy and millions of people's lives. In this video, we're going to take a deep dive into the causes and effects of the crisis and explore how it all started. We'll uncover the complex web of financial instruments, regulatory failures, and societal factors that came together to create the perfect storm. Whether you're a seasoned economist or someone who's just curious about what happened, this video is for you. So get ready to learn about one of the most significant events in modern economic history. This is the story of the 2008 financial crisis. Part 1. What caused the crisis? The 2008 financial crisis was one of the worst economic disasters in modern history. It began in the United States, but quickly spread to other countries around the world, causing widespread job losses, home foreclosures, and business bankruptcies. The crisis was triggered by a combination of factors, including risky lending practices, a housing market bubble, and financial speculation. To understand how the crisis happened, we need to go back to the early 2000s, when the US housing market was booming. Banks and mortgage lenders were eager to lend money to home buyers, even those who couldn't afford it. They did this by offering subprime mortgages, which were loans given to people with poor credit histories or low incomes. These mortgages often had adjustable interest rates, which meant that the monthly payments could increase significantly over time. At the same time, investment banks were creating complex financial instruments called mortgage-backed securities (MBS). MBS were made up of bundles of these subprime mortgages, and they were sold to investors all over the world. These securities were considered safe investments because they were backed by the value of the underlying homes. However, as more and more subprime mortgages were issued, the quality of the loans began to decline. Borrowers who couldn't afford their payments began defaulting on their loans, leading to a sharp increase in foreclosures. As home prices began to fall, many homeowners found themselves owing more on their mortgages than their homes were worth, which made it impossible to refinance or sell their homes. This created a downward spiral that ultimately led to the collapse of the housing market and the financial crisis. Part 2. How did the crisis spread? The mortgages which people could not afford were often packaged together into securities and sold to investors around the world, with credit rating agencies giving them high ratings despite their risky nature. This allowed the risks of the subprime mortgage market to spread throughout the global financial system. The financial industry also developed complex financial instruments, such as collateralized debt obligations (CDOs) and credit default swaps (CDS), which were meant to spread risk and increase liquidity. However, these instruments ended up being abused by financial institutions, which used them to take on excessive risk and bet against the housing market. As housing prices began to fall in 2006 and 2007, many homeowners found themselves unable to make their mortgage payments, leading to a wave of defaults and foreclosures. This caused the value of mortgage-backed securities and other related investments to plummet, leading to massive losses for investors and financial institutions. At the same time, many of the banks and financial institutions that had bet heavily on the housing market began to collapse. This included major players like Lehman Brothers, Bear Stearns, and AIG. As these institutions failed, they sparked a chain reaction throughout the financial system, with other institutions also experiencing significant losses and facing the risk of collapse. The crisis had a major impact on the global economy, leading to widespread job losses, foreclosures, and bankruptcies. Governments around the world were forced to intervene with massive bailouts and stimulus packages to prevent a complete collapse of the financial system and stabilize the economy. Part 3. The aftermath of the crisis. The 2008 financial crisis had far-reaching consequences, both in the United States and around the world. The US economy was hit hard, with millions of people losing their jobs, homes, and retirement savings. The crisis also had a ripple effect on other economies around the world, particularly in Europe, which was already struggling with its own economic challenges. In response to the crisis, the US government implemented a number of measures to stabilize the economy. One of the most significant was the Troubled Asset Relief Program (TARP), which was signed into law by President George W. Bush in October 2008. The program authorized the US Treasury to spend up to $700 billion to purchase troubled assets, such as mortgage-backed securities, from banks and other financial institutions. The Federal Reserve also took a number of steps to stabilize the financial system, including injecting trillions of dollars into the banking system through a process known as quantitative easing. The central bank also lowered interest rates to near zero in an effort to encourage borrowing and stimulate economic growth. Despite these efforts, the US economy continued to struggle for several years after the crisis. Unemployment rose from 4.6% in 2007 to 10% in 2009, and many Americans found it difficult to secure credit or obtain loans. The housing market, which had been a major contributor to the crisis, also remained weak. In addition to the economic consequences, the crisis also had political and social implications. Many Americans became disillusioned with the government and the financial system, and there was a growing sense of anger and frustration among the public. This, in turn, led to the rise of populist movements and the election of politicians who promised to shake up the system and hold Wall Street accountable for its role in the crisis. The crisis led to a sharp decline in global stock markets, with the Dow Jones Industrial Average falling by more than 50% from its peak in October 2007 to its low in March 2009. The crisis also led to significant declines in other global stock markets, including the FTSE 100 in the UK, the Nikkei 225 in Japan, and the DAX in Germany. One of the most notable impacts of the crisis was the sharp decline in international trade. As the crisis hit, consumer demand plummeted, leading to a reduction in global trade volumes. This, in turn, led to a decline in commodity prices and reduced economic growth in many emerging market economies that were reliant on exports. Many countries also saw their currencies depreciate in value as a result of the crisis. This made imports more expensive, contributing to rising inflation in some countries. Developing nations with high levels of external debt were particularly hard hit, as the value of their debt increased as their currencies depreciated. The crisis also had significant impacts on international financial markets. The collapse of major financial institutions in the US triggered a wave of bank failures and consolidations around the world. Many countries were forced to bail out their own banking sectors to prevent a complete collapse of their financial systems. Perhaps the most visible impact of the crisis was the rise in unemployment around the world. As the global economy slowed down, many companies were forced to lay off workers to cut costs. This had a significant impact on households and communities, leading to increased poverty and social unrest in many countries. The crisis also exposed weaknesses in the global financial system, leading to calls for increased regulation and oversight of the banking industry. There are several important lessons that we can learn from the 2008 financial crisis. Here are 5 key takeaways. 1. The importance of regulation. The financial crisis exposed significant weaknesses in the regulatory system. It became clear that financial institutions were taking excessive risks, and regulators were not doing enough to prevent this. The crisis underscored the importance of strong regulations to ensure that financial institutions operate in a safe and sound manner. 2. The dangers of complex financial products. The financial crisis was triggered in part by the widespread use of complex financial products such as mortgage-backed securities, credit default swaps, and collateralized debt obligations. These products were so complex that even sophisticated investors did not fully understand the risks involved. The crisis highlighted the dangers of such products and the need for greater transparency and simplicity in financial markets. 3. The need for better risk management. Many of the financial institutions that failed during the crisis had inadequate risk management systems. They did not properly assess the risks of their investments, and they did not have adequate controls in place to mitigate those risks. The crisis showed the importance of effective risk management practices to ensure the stability of financial institutions. 4. The importance of liquidity. During the crisis, many financial institutions faced a liquidity crunch. They did not have sufficient cash on hand to meet their obligations, and this led to a cascade of failures. The crisis highlighted the importance of liquidity and the need for financial institutions to maintain sufficient cash reserves to withstand periods of stress. 5. The dangers of interconnectedness. The financial crisis demonstrated the dangers of interconnectedness in the global financial system. The failure of one institution could quickly spread to others, leading to a systemic crisis. The crisis underscored the need for better coordination and collaboration among regulators and financial institutions to prevent and manage such crises. Whilst these are good lessons, have we actually made any changes to stop this happening again? Some progress has been made, and these are a few examples. Increased regulatory oversight. Governments around the world have increased regulatory oversight of the financial industry. In the US, for example, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in 2010 to regulate financial markets and protect consumers. The act created several new agencies and regulations aimed at preventing another financial crisis. Strengthened capital requirements. Banks and financial institutions are now required to hold more capital to protect against potential losses. The Basel III Agreement, signed in 2010, required banks to increase their capital ratios and improve risk management practices. Increased transparency. There has been a push for greater transparency in financial markets, with new regulations requiring more disclosure of financial information. This helps to prevent the kind of opaque and complex financial products that contributed to the 2008 crisis. International cooperation. International bodies like the G20 have worked to coordinate regulatory efforts and increase global cooperation in financial regulation. This has helped to create more consistency and standardization in financial regulation across countries. While these changes are a good step, they do not guarantee that another financial crisis will not occur. In fact, here we are in early 2023, and there are severe stresses in the global financial system, with a series of shocks that have led to fears of another banking crisis. Banks are experiencing losses due to rising inflation and the reversal of quantitative easing by central banks. The collapse of Silicon Valley Bank SVB and other banks has raised concerns, although banks are in better financial shape than in 2008. Central banks have set up lines of credit to help banks with cash flow problems, but the tension between keeping inflation low and maintaining financial stability has left central banks in a bind. The risks of recession have increased significantly in the past weeks. Despite the economic, political, and social fallout of the 2008 financial crisis, it remains an important historic event to study and understand. By exploring the complex factors that led to the crisis, we can better prepare ourselves to prevent similar events in the future. We can also gain a deeper understanding of the ways in which the global economy is interconnected and how financial decisions can have far-reaching consequences. Thanks for watching. Please comment, share, like, subscribe, and switch notifications on. The story continues.